Hello everyone, welcome to my YouTube channel. My name is Madhusmita and today's my topic is enterprise value of a firm. What is enterprise value of a firm? Once you started delving deeper into valuation and especially in the premises of merger and acquisition, you notice that enterprise value is an essential term in this field. A company's value consists of its own assessor, but and really obtaining their market value can be tedious and resources intensive. Following the accounting equation, we can value this by the shareholders' equity and liabilities, which the company used to finance its assets. By considering the market value of the firm's equity and liability, we can derive the current market value of the business. It helps analysts to evaluate potential new investment opportunity. The EV matrix is vital because it's affected by capital structure, but only by the core operation of the business to move away from the market value of equity of the business and over to term investment and add all liability which are the items that represent all the other investor. Enterprise value in a nutshell. What is enterprise value in a nutshell? Let's see. To put it simply, enterprise value EV is a modification of market capitalization, that is market cap, that includes debt and cash. It is a useful matrix when it performs company's valuation. The matrix is also known as total enterprise value and total firm value. Enterprise value tells us the worth of the company, which is a theoretical price of taking over the business. Before considering the takeover premium, it counts for the debt and cash balance to acquire will also assume. The matrix look at total market value and is useful to compare companies with different capital structure. That's why EV considered as shareholder interest and claim on assets both from debt and equity. EV have captured the total value of business and is a more accurate and comprehensive representation. It is the minimum an investor would pay the acquire of a company. The matrix helps investor to make appropriate decision considering the market capitalization together with the debt and cash position to the company. It is a more accurate interpretation of market cap. Enterprise value serves a twofold purpose: to calculate the cost of the to acquire the whole business, a capital nurture valuation to compare companies. When we evaluate a business with its EV, it is crucial to pay attention to how the company uses its debt and liabilities. Soon firm within capital intensive industries carry lot of debt to facilitate growth. This impact the enterprise value and make comparison of such firm to one within other industry highly inaccurate. Therefore, it's usually a good idea to use EV to compare companies with the same industry. Enterprise value calculation. What is enterprise value calculation? We calculate the matrix with the following formula. Market capitalization is the value of the common shares of the company. We derive the market value of equity by multiplying the total outstanding share of the company by the current market price and market price of the stock. If you plan to acquire a company, you need to pay at least the market cap value This alone is not an accurate measure to the total cost of the business. So, enterprise value consider other company as well. Preferred stock displays the feature of both debt and equity. Preferred share have a higher priority in assets claim than common stock, and they pay cut a fixed dividend. We treat this as debt as they usually have to repaid in an acquisition. Debt include all liabilities of the company. These are interest bearing loans and borrowing that represents the contribution of the company by the bank and the creditors. An acquirer assumes liability for all debts of the company. Therefore, debt increasing the purchasing cost, and we add to the enterprise value calculation. By including debt which has been paid by the acquirer, the EV provide a more accurate takeover value. If there's no way to determine the market value of debt, we can use the book value instead. We deduct cash as in theory the acquirer can use the company's money to cover a portion of this debt. NCI or majority interest represents the portion of subsidiaries that is held by the minority shareholders, meaning the parent entity does not own it. We added to ensure 100% of the subsidiary value is in EV. That's why the calculation reflects the parent showing 100% of the subsidiary performance in it consolidates financial statement even if owning less than that. Cash is the most liquid assets and include cash on hand and in bank accounts as well. Any highly liquid short-term investment and marketable securities, as we can easily translate this into monetary funds. We deduct cash from the EV calculations and it reduce the cost of acquisition. The acquirer can use it either to cover the purchase price or to pay out debt and dividend. Sample enterprise value calculation. Here's a sample example. You can see here here's a sample example of how we might approach calculating and comparing the enterprise value of the three companies. See the formula and explanation outline above. We can fill in the template and arrive at the EV of the each entity. First is the example enterprise value calculation, that is outstanding share, then which is 510, then share price of market. After that, market value of equity plus debt plus preference stock plus minority interest, and which is subtracted by the cash and short term investment, and we get enterprise value. So running the calculation, we arrive at a theoretical acquisition cost of 16,000 for our second and third company we get respectively. It is important to note that company C has the highest market cap, market value of equity out of the three, more than 20 times over. However, due to a large amount of cash retained within the business, the enterprise value is significantly low, meaning the theoretical cost of the acquisition is low, that for company A and B, because we will get 165,000 to cover debt and liabilities. Then next is Reliance Industry enterprise value. So you can see the value of the enterprise. Reliance Industries enterprise value distribution for the oil and gas industries and energy sector. So Reliance Industry enterprise value distribution chart can be followed below. The bar in red indicates where Reliance Industries enterprise value falls into. Okay. So hope you all understood what is analysis of financial statement and enterprise value of a firm. Thank you so much.